it is my pleasure, dear Ariane, to invite you to join me on stage and kick off this 7th edition of IPEM.
Thank you very much. Thank you. Ladies and gentlemen, good afternoon. Being here is both pleasing and essential to put an emphasis on today's challenges. More than ever, it is our collective responsibility to act. I would like to start by thanking Antoine and all the organizers for this invitation. This event has become a major rendezvous for the industry, and it is a fantastic opportunity to use this gathering to build on solid foundations, building on new foundations. To talk on such a subject may seem ambitious in a world in such turmoil and rapid transformation. But it is because there has been so much change and at such a pace that solid, stable foundations are essential to the continued success of private equity and the sustainability of its performance. In the last 10 years, it has been the star asset class. I would like to highlight 3 major areas of success. Fundraising. Global funds raised across the full private capital spectrum hit $1.1 trillion in 2021. Record transactions. Deal makers were busier than ever, deploying more than $3.5 trillion across asset classes. Performance. The 5th consecutive year, private equity was the highest performing private market asset class and continued to outperform most public market equivalent. Today, these successes are challenged. Our industry is now facing a highly volatile, unpredictable, and tougher environment. To start, for some very boring, let me briefly present a broad macroeconomic overview. The Sino-American conflict, the pandemic, and the Russian-Ukrainian war are forcing us to rethink world balances. In addition, after zero lower bound or negative interest rates, central banks have had to raise their interest rates to follow the Federal Reserve's lead in taking action to fight inflation. In a context of huge uncertainty, I think this is good news for the medium term, as it shows that the Federal Reserve is determined to respect its mandate. The credibility of the Fed is the first source of financial stability, and it is essential for our industry. The Federal Reserve wants to show that will not allow runaway inflation. After starting an interest rate hike cycle last March, it surprised the markets by raising rates by 0.75% in July, bringing them to a range between 2.25 and 2.5. Today, the Fed is still seeking to cool off the strong demand, which is not normalizing. According to our Economic Research Department models, key rates should rise between 3.75 to 4%, and the consequence will likely be a recession in the US by early 2023. By doing so, the Fed is prioritizing the fight against inflation at the expense of unemployment and thus returning to a monetary policy dedicated to price stability, as was the case during the 2008 crisis. Furthermore, the Fed has begun selling its sovereign bonds as well as mortgage-backed financial assets. It has stopped artificially altering the prices of equities, bonds, and real estate, and is thus pushing savers, business leaders, and investors to shift risks. As a matter of fact, low interest rates had aggravated financial imbalances and unreasonably inflated asset prices. Consequently, we will go back to basics, return to true value creation using the right tools and skills in our selection processes. As for the Eurozone, it has to face a triple punishment. 1, imported inflation from the US. 2, the rise in energy and food prices aggravated by the Russia-Ukrainian war. And 3, a monetary policy dictated by external events. The only good news comes from the euro's depreciation, which should boost exports and partly offset rising production costs due to the gas price shock. Emerging countries, for their part, must raise their key rates, while food prices are weighing on household consumption. We are on a ridgeline. Global GDP growth should decelerate until the Fed manages to reverse their inflationary peak. So until then, the global GDP growth outlook is dark. On top of the cyclical inflationary pressures, I believe there's a geopolitical paradigm shift, which may provide new opportunities. We're facing 4 key challenges. The first is the reorganization of the world around US-China trade war, which is, for me, one of the most significant and structural challenges of the 21st century, for 2 reasons. It polarizes the balance of power around these 2 giants, increasing the importance of value chains, energy, and food independence. We're moving from globalization to regionalization. This will mean for developing countries a significant step back in terms of freedom of trade. As for developed countries, the potential risk will be to put diplomatic and geopolitical choices above growth. The second challenge is Europe's anemic growth compared to the US. The US remains a remarkable, resilient economy, particularly when compared to Europe's sluggish growth figures. America's recent economic performance is impressive. It took only a year for the US GDP to recover to that of 2019. US GDP has now even exceeded the levels it would have reached, notwithstanding the disruption of the pandemic, whereas GDP of the Eurozone has only just recovered its 2019 level. The output gap is plus 1.3% for the US compared to minus 1% for the Eurozone, according to our calculations. European countries are now out of step with the US on economic growth, and this puts the European Central Bank in a difficult position. The third challenge is energy transition. The EU is a leader aiming for climate neutrality by 2050. By making the energy transition a central objective of its energy policy, Europe, in the short term, is putting itself at a disadvantage compared to the US and China. However, I expect the EU strategy to succeed in the long run because without transition, growth will not be sustainable. The fourth and last challenge is sovereign food security. As I had anticipated for many years, food is and will be one of the key challenges for us all to address. Food prices have risen by 40% in the last year alone. According to our research department, this will generate an additional 5% inflation in emerging countries and 1.5% in developed countries. This creates a true sense of emergency and drives us to action. These global economic and geopolitical tensions have already had an impact on the first half of 2022. Facing the new monetary policies and these radical disruptions, private equity fundraising has become more challenging. Transaction activity, however, will remain resilient with a record 1.4 trillion of dry powder by seizing good opportunities at fair market prices. Let me now address the new foundations needed to continue the private equity success story. First, I believe that private equity investments have to be conviction-driven. My family, since the 19th century, has invested in greenfield projects such as infrastructure and energy to further enhance economic development. As examples, in 1837, James de Rothschild was the anchor investor of the first railway company called la Compagnie des Chemins de Fer du Nord. And at the same time, Lionel de Rothschild helped finance the Suez Canal, which fundamentally changed trade routes between Asia and Europe. Today, I have the same vision of what an investment should be. It should be impactful, coupled with long-term value creation. This is how our private equity funds invest. Let me give you 2 examples. 14 years ago, we tackled the problem of urban sprawl and its impact on arable lands. It was about trying to match densely populated and economically competitive regions with a shortage of developable land at an abundant form of heavily polluted industrial sites. We created our Sustainable Urban Development Private Equity Fund, valuing abandoned industrial sites, building the city on the city, revitalizing it with attractive mixed-use schemes where people can live and work in a preserved bio-ecosystem. As of 2022, 100 hectares are being rehabilitated and redeveloped through 24 projects in 6 countries. As you may know, I grew up in Africa and have kept a strong attachment to this continent. Rapid climate change will lead to large and significant population movements. This will be one of the major challenges of our century, and Africa will be the first to be affected. This is why we have created a chair in the economics of international migration with the Paris School of Economics. There is a real window of opportunity as we are moving to more regionalization. We can help bridge the gap. In 2012, we launched our strategy dedicated to growth in Africa by investing in local small SMEs. I'm convinced that supporting their development will allow the emergence of a middle class that directly benefits the economy. In the past 10 years, we have successfully invested in more than 30 companies, amongst which healthcare, consumer goods, education, and agriculture. I am more convinced than ever that we must support the continent's growth through sustainable solutions. In a nutshell, being conviction-driven leads us to tackling socially and economically complex trends and issues with the tools that private equity provides. Focusing on highly specialized greenfield projects give us the greatest possible leverage in terms of performance and impact. The second foundation needed to continue this success story is intentionality. To be impactful, we must understand that our investments need to be intentional, additional, and measurable. Intentionality means that your investment is built to have an impact. As an example, our investments in micro-irrigation systems help save 100 million cubic meters of water a year, equivalent to the annual consumption of 4 million people in water-stressed Morocco. Additionality indicates that the impact you want to achieve can only be achieved by you. Again, as an example, our investment in a miller in Mozambique enables the distribution of 50% of the country's flour. It provides bread to nearly a fifth of the population in one of the poorest countries in the world. This is possible thanks to the understanding of local needs and problems and the presence of our experts on the ground. Measurability expresses the need to have a clear reporting of what you do and achieve. ESG is not about ticking boxes. It is about accountability and transparency, and I strongly believe it is here to stay. Unfortunately, greenwashing has now become so prevalent and damaging that clients are at best confused and often very suspicious of ESG claims. It is becoming clear that regulators and investors will not trust our industry without additional controls and inspections. We need to work hand in hand with regulators for the investors' interest. The new standards to measure performance and carried interest are increasingly based on measurable impact indicators on top of long-term value creation. And I believe this is positive for our industry. My third and final foundation is the absolute necessity to have highly efficient operational platforms. Private equity as an asset class has matured from being a pure deal maker in the 80s to a regulated and standardized industry. We need to have a key focus to branding and improve our distribution capabilities through a first-class operational backbone. Technology is the key enabler to this. In addition, the increased cost of operational support is becoming prohibitive to small players. Combined with negative pressure on fees, it will be very difficult for them to continue to meet client expectations. This will inevitably lead to the consolidation in the industry, a shift witnessed by traditional asset management 10 years ago. Today, there's a trend towards democratization of real assets. Marketing and selling illiquid long-term asset classes into short-term liquid products, and I think you will tackle the issue later, should be executed with the greatest care. Retail investors must be managed within a strong governance framework in order to avoid misunderstandings and potential reputational damages. Let's not make the same mistakes that led to the financial crisis of 2007. The challenges we are facing today are enormous, but the opportunities to take action are equally immense. This is a historic moment. Private equity has all the tools to capitalize in this turbulent period and accompany a changing world. Alignment of interest remains the driver of any business. If we want to play a leading role in this transformation, we must invest differently and make good use of the dry powder at our disposal. We must avoid short-term speculative strategies, but rather focus on long-term value creation without excessive leverage. Let's all live up to this responsibility. It's the only way to a sustainable future. Thank you.
Thank you very much, dear Ariane, for those comments. It's very true that the IPEM community returns to Cannes at a pivotal and very challenging moment to the industry's future. Inspiring action is what this show is all about. So we look forward over the next 3 days to hear how firms are preparing themselves for the task at hand.